I want to follow up on something you said actually at Jackson Hole. You were talking about longer-term structural challenges for the economy, and you mentioned that addressing the federal budget deficit, which has long been on an unsustainable path, becomes increasingly important as a larger share of the population retires. I'm just wondering if you could maybe expand on your thoughts there, and if this is an issue that comes up among members of the FOMC at all.
So it doesn't really come up. It's not really our job. And we do monetary policy. We regulate financial institutions, financial stability, that sort of thing. We don't have responsibility for fiscal policy. But in the longer run, fiscal policy will have a significant effect on the economy. So for that reason, I think my predecessors have commented on fiscal policy, but they've commented on at a high level rather than trying to get involved in particular measures. And so, my plan is to kind of stick to the same approach and stay in our lane. And so I would just say it's no secret. It's been true for a long time that with our uniquely expensive healthcare delivery system and the aging of our population, we've been on an unsustainable fiscal path for a long time. And there's no hiding from it. In the end, we will have to face that. And I think the sooner the better. And also, these are good times. These are This is the economy at nearly full employment or in the range, in the neighborhood of full employment. Interest rates are low. It's a good time to be addressing these things. So I put that out there and leave it at that.
I'm Takeshi Kanami from Nikkei newspaper. Thank you for taking my question. I'd like to ask about emerging market. What do you think about the impact of U.S. monetary policy on emerging market, especially currency depression or capital outflow from emerging countries? And do you think there is a possibility to stop the interest rate hike due to emerging market turmoil, due to turmoil of emerging market?
Sorry, the second question was?
There's a possibility to stop the interest rate hike.
Okay. All right. We serve a domestic mandate, which is assigned to us by Congress. And that is to have maximum employment at stable prices. About half of global GDP is outside the United States, and way more than half of the growth is outside the United States and in emerging markets, I should say. And so the performance of the emerging market economies really matters to us in carrying out our domestic mandate. I'd also say that a strong U.S. economy where Americans are buying things and the economy is growing and that's going to support demand all around the globe. So that's a good thing. Now, we do understand though that when our economy is strong and we're raising rates, that puts upward pressure on interest rates around the world and can affect countries, particularly countries that have significant external dollar borrowing. And what we try to do is be very transparent about what we're doing and why, and we have been, I believe, and we've also moved quite gradually. So I think we've been performing well on that front. There are some countries that are undergoing severe stress, a handful of them, but not most emerging market countries. It's a relatively small number, and those particular countries have particular vulnerabilities, which are well known in the form of budget deficits and significant external dollar borrowings and high inflation and things like that. So, again, we'll continue to conduct U.S. monetary policy as transparently as we possibly can, and that's really the best thing we can do, along with supporting U.S. growth. I think that answers both your questions, actually.